if you have cheap money from central banks, they've lowered interest rates down to zero. And the big institutions of the world are throwing money at VC funds that are throwing money into these companies, and they don't care if they ever make a profit. And they're just looking for growth, in a frenzy for growth. And there's no assessment of value. Then other brick and mortar companies that are seeking to earn a profit and have to pay people and are actually looking to a long-term survival have to compete against these new disruptive technologies, but that are actually being subsidized by inexpensive money. To what point are central banks crowding out value investors?
That's a great question. I think that it's been a great time for consumers. There's been enormous consumer surplus subsidized by the VCs on Sand Hill Road, and that's been great for everybody. You get cheaper taxi rides, among other things. What drives that? Potentially that's too low interest rates making marginal business ventures look better than they would otherwise look. If your cost of money is virtually zero, then if you can get a return anywhere that's a little better than virtually zero cost of money, then that's a project that you should probably be investing in. So that's one of the problems, that interest rates being set too low or flooding the market with money creates that better businesses aren't rewarded for being better businesses. Being a careful husband of the cash on your balance sheet, that's not rewarded at all. Spending it to grow is rewarded. So the way that is reflected is in that duration trade where, the 30-year, when interest rates move, the 30-year moves a lot more than the 10-year. So the 10-year is more like a value stock, or value stocks are shorter duration because their cash flows are front-end loaded. You buy cheap cash flows now, perhaps expecting that there's not going to be as much growth, or there might be a little decline in the cash flows of the value stocks. Whereas the growth stocks, they're not earning any cash flows now. All of the cash flows are back-end loaded to the extent that they're going to make any cash flows at all, but that's the expectation. So when you move interest rates a little bit, you get wild moves from the growth stocks. You drop interest rates, you get wild moves up from the growth stocks. Value stocks don't tend to be as sensitive. So maybe interest rates need to go up for value to start working. I've heard that argument. I think that's a very good argument. The problem is that I think there are lots of really good arguments for why value hasn't worked, and there are some of them going to be right in retrospect and some of them are going to be wrong. I think ultimately, as a value investor, you can overcomplicate things by trying to figure out the macro driving those side effects or those phenomena. And I think that you can simplify it as a value investor. You can simplify it for yourself by just working out if the individual company that you're looking at is in fact undervalued, and then looking at, to your point, are there irrational actors who they're competing with? Sometimes that's a good thing. That's what creates the undervaluation. And then can that non-rational, non-economic actor survive, or will they be washed away eventually? I think that that's some of what we've seen over the last 5 years, that there's been an expectation that at some stage that flood of money that spigot will get turned off at some stage. And so you'll be rewarded for doing the analysis, looking at the balance sheet, looking at the strength of the business, the quality of the cash flows that it's generating, but not yet.
So it has a similar dynamic to, I would say, volatility, where you can suppress volatility, but the more you suppress it, you can suppress it for a long time, but the more you suppress it, the more it will realize itself in other ways and eventually come out even greater than before.
Well, you have the great analogy of burning back the tinder in the tall trees.
The sequoia forest.
The sequoia forest, and if you don't burn it back, that creates these explosive wildfires. And I think that's true also. That little bit of interest rate volatility or a little bit of higher rates sort of strengthens these companies. It makes them better companies, better businesses, better managements. And when they get fat and happy because there's the tinder's not being burnt back on a regular basis, that's when they set themselves up for a big crash at some stage.
It's the same concept. The longer the period of value underperformance, in essence, the greater the value proposition becomes on the other end of it for those who are patient.
Or those who can survive too. You have to survive.
That's right, the business risk.
Because this is the problem. Value has sort of become a little bit of a laughing stock. There aren't very many traditional value guys around because it's so hard to maintain. It's hard to keep investors. when you can get, for basis points, you can get access to the index, and the index is the best performing asset in the world. So then that makes any other active look pretty ugly, and particularly when any other active wants to charge a slightly higher fee. But again, that's ahistorical. It's not something that these trees don't grow to the sky at some stage. There is that reckoning, and so I fully expect it to happen at some stage. I'm not predicting one in the short term or in the medium term. I'm not predicting one at all. The market, I think, if I've learned anything over the last decade or so, it's that the market is unpredictable and humbling at every stage, and so you never want to make a prediction about the future. But I would prefer to be, at this stage, in something like a value strategy than in the index or in low volatility or momentum, because I think that value is really the only thing that can provide returns over the next decade that are absolute or relatively better than anything else out there. I think everything else is going to have a very tough run over the next decade.
It was almost a decade ago, I remember, when someone asked us, there was a young kid who wanted to go on Wall Street, and somebody asked us to give him advice or something. So we took him out for drinks. I remember we sat down, and this poor kid, we were like, you need to go find the sector that is the most depressed sector imaginable. Get into that sector, everyone will hate it. And by the time you're a vice president, you'll be the only person who knows anything about it, and the sector will be doing really well.
That's great advice.
It's great.
Why did we do that?
Right, exactly. But now you can't find any more too depressed sectors than value investing and or disciplines than value investing and volatility, long volatility trading.
Well, I think one of the things about value is that value's that movable feast. Value's always going to where the disaster is, or where nothing's happened for a long time. So value at the moment looks like it's pretty heavily into financials and energy and miners and sort of heavy industry, which haven't done much for a long period of time. So we hold a lot of financials, and we've got some energy exposure too. Part of the underperformance of value has been that sector mismatch or the industry mismatch. So if you've been a value investor in technology, you would have outperformed any sort of naive market capitalization weighted implementation of that. The problem, if you're investing across every sector or every industry, is that you're more heavily weighted towards financials and other things that haven't done as well. Now, the financials, the reason for the underperformance is probably twofold. Interest rates are probably hurting financials, and the memories of 2007 to 2009 still very vivid in anybody who lived through that period, and so they're wary, and rightly so, of banks and insurers that could be hiding some sort of liability on their balance sheet that nobody knows about.